So I dropped down to the Euro USD 15 minutes time frame. Considering the same strategy, what you have in front of you is the weekly, is the 15 minutes time frame, and I've gone back to the beginning of the week because right now it's the weekend, it's Saturday, and the market has closed. So I wanted to see what has happened throughout the week in all these major pairs. So the Euro USD, when the week started, we have this thing known as psychological support and resistance, and it's basically the movements that are determined by what happens the first 8 hours of the week. So let me illustrate this with the 1 hour time frame. And what this means is that you count the first 8 candles beginning of the week, and the high and low of those candles mark the psychological support and resistance. So for this one, this is 1, 2, 3, 4, 5, 6, 7, 8. So up to this point, the 8th candle, you look at the highest point and the lowest point beginning of that week to draw these lines of the psychological support and resistance. And so the lowest point was here. So the lines is drawn here. And the highest point, even though 8 hours ended here, but the highest point was actually when market, 4 hours after, 1 hour after market opened. So it is at this point. So to repeat, the psychological support and resistance are made of the highest point and the lowest point within the first 8 hours after market opens in the beginning of the week. So 1, 2, 3, 4, 5, 6, 7, 8. The lowest point was here, so the line was drawn here, and the highest point was here. And so what usually happens is that in the beginning of the week, you have the false move at the beginning of the week. So when market opened, the pair started selling. Normally, you usually have a false move, and then it started rising, because we usually say that there's false move beginning and end of any session. So for this session, meaning the weekly session, beginning of the week, you had a false move of selling, basically the stop hunt of the beginning of the week. So the pair sold, and then all of a sudden it started buying. It went back into the psychological support and resistance, and it started buying for 3 days, okay, until it reached the midweek reversal. Because a pair cannot just go on buying and buying and buying forever. There's a limit of how far it can go. So after it reached, and that is why we usually say 3 times ADR, because roughly the estimate is that the pair will move to 2 times the average daily movement. Of course, at this point, up to the midpoint, it had reached 147 pips. And it didn't really complete the 3 times ADR, but it did reach a quarter point. So then it started dropping, and after 3 days. And when it went back into the psychological support and resistance and out of it. So I want to count the pips that were moved from this point, from the highest point of the week, and up to here, and it was 184. So yes, so those were the movements in the week. So you will just add, just to get the total movement, you'll add the buy, which was let's just say 150, and then you'll add the sell, which again is just, there's a point on and you'll straight here, the sell, which was again up to the lowest point, 180. Okay, so that was the midweek reversal, this highest point here. And I'm just going to do a very quick calculation. 150 plus 180 is 330. So completed an average daily movement, and it actually exceeded it. Another point I want to stress is the crossing of the moving averages. For this strategy, you will look at the crossing of the ketchup and we look at the crossing of the red and the blue moving average, the 13 moving average and the 50 moving average. And when it crosses, that is when you can enter a buy trade. And if you decide to just take a few pips, you will be out. Of course, this is the 1 hour time frame. You'll be out at the highest point was like 37 pips, but it would have been highly profitable if you had swing traded it and if you had carried it up till the end of the week. However, let me drop down to the 50 minutes time frame. It's easy to show it in the 50 minutes time frame. In the 1 hour time frame, the 1350 cross gives you more accurate entries but less entries. In the 50 minutes time frame, you get more entries and less accurate but more entries and earlier entries. That means you get more pips entering in the 15 minutes time frame because you are entering earlier compared to when you're entering in a 1 hour time frame whereby you're entering late, so you get less pips. But they are more accurate because the chances of the crossing reversing are low. So let me zoom out. I'm still going to the beginning of the week. Again, we had a false move beginning of the week, and then we got the 1350 cross, and that is when you would have entered. And so after this point, pair started going in an uptrend. As I said, you could have, if you're a day trader, you just take 40 or 50 pips and you get out. Or if you're a swing trader, you swing with it until the pair closes below the moving average that you've assigned it. For example, if it closes below, you can decide if it closes below the 200 moving average, you are out. So for this, at this point, you could have been out. Or if it closes below the blue moving average, the 800, signifying a change of direction, then you're out. So it is your choice on how you use this strategy. So for now, we can say for the 15 minutes time frame, if it closes below blue, if the candle closes below the blue moving average, you decide to look for an exit. For the 1 hour time frame, if it closes below the red, you look for an exit. So, so for this point, the exit would have been here. You could have re-entered, but it would have been a short re-entry because it could have been a short re-entry because it went back and closed again. So I'm trying to see. So this was some sort of consolidation, and there were news here, there were midterm election results. So it's not surprising there. So could have gone back in and continued with the uptrend up till here until it closed somewhere below here or below here for you to get out of the entry. This would be a very early exit, and this would be a late exit. So let me go to another pair, GBP USD. I'm also going to go down to the lower time frame, 50 minutes time frame. Again, I'll mention the psychological support and resistance. Beginning of the week for the 1 hour time frame, it is 8 candles. So it's easier to count it in a, let me just go to the time frame and I'll zoom in really quick. Yes, so here it is. 1, 2, 3, 4, 5, 6, 7, 8. So up to this point, the highest point and the lowest point will be where the lines will be drawn, and this was the highest point and this was the lowest point. Okay, so these form your psychological support and resistance. Again, we place a trade when pair goes on either one of this side to show you the general direction, the general trend of the week. So for our pair, it several times it went below, but then it kept going back up. And you could actually say that this was a W however, like showing you a reversal pattern or a triple W. But basically, if you're going to drop down into the 50 minutes time frame, it could have shown you the 1350 cross and the point where you could enter. So here we are. This was the beginning of the week. Because it was consolidating, there were several 1350 crosses. So some of these crosses are false because you're in the lower time frame. That's why I said the ones in the higher time frame are more accurate. However, this was another cross. And what is more significant isn't the crossing, it's actually the quarter point, as you can see this red here. So once this candle closed above the quarter point and you saw the 1350 cross, it was enough for you to give you confidence to enter this trade as a buy, especially considering this W. This W. So there's a W shape here, and this is the second leg of the W. The second leg having been formed, there was a 1350 cross and a closing of the candle above the wall quarter point. So this was enough signal to make you buy this pair for however length you preferred. If you prefer to buy this pair until it closed below, there was no closing here, it went up, you could have continued buying this pair. The closing below was around here. So, or you could decide if it closes below the red, whichever your choice. So if it's a close below the red moving average, it was here. So this is where you could have exited. And this was 50 pips. If it was closing, you could have exited, but with very low. If it was closing below the blue, you could have exited with 30 pips. However, if you're moving from quarter point to quarter point, you could have waited for the quarter point to be completed. If you are counting ADR, I mean 3 times ADR, or if you are waiting for a close below the 200 moving average, then you could have continued with this pair. For the rest of the week until around here, the 8th of November, that is when it went and touched the, let me zoom out, it touched the 200 moving average. So it is just your choice on how you use these moving averages. It's a strategy that you learn about it and you modify it according to your preference, according to how long you prefer to hold the trade, according to how many pips you wish to use, and so forth. So on all these pairs, you drop down to the 50 minutes time frame and you look for entry. So you may not always find a 1350 cross. If you don't, then it is okay. If you find a cross has already occurred, then you can enter as long as pair is above. For example, let me go to a pair that I've not discussed. Maybe USD card. So let's say you woke up in the morning and you found this cross has already occurred. Of course, it occurred the day before in the New York session. But let's just say when you got on the trade, you found the cross has already occurred. As long as the pair is trending above the moving average, you're still safe to enter. And as long as you know that the pips have not been reached, the ADR movement, if not even a half, has not been reached, you can still enter. But of course, you'll be having a late entry, and there's always a risk for the price to trace back down, but it's still okay. So what you could do is wait for a retracement and a bounce, because price usually always bounces off the 15 moving average. So you could wait for price to go back and bounce off this and then enter trades. A bounce like this, and then a close above, and then a safe entry. So this showed that this was a retracement at this point here. And so you waited for the bounce. It happened for the retracement, and we call this the 50 bounce, and then you entered, and this would have given you confidently 50 pips. So you have two choices. After the cross has occurred, you can risk it and enter immediately as you see it, or you can wait for retracement and enter. So always look for the 1350 cross in history, in the pair, and then to give you the general direction at the moment, and know whether you are By looking at the higher time frame, know whether you're trading the trend or the retracement, but whichever the case, just have a good entry after the retracement. And yes, the same thing can be applied on all time frames. So this is the Audi USD. Of course, it had been on a downtrend, but for last week, it began. Let me zoom out. Okay. Yes, it went up and then it went down from the beginning of the week to the end of the week. Okay, this is the day, from the beginning of the day to the end of the day. And this is New Zealand USD, the same thing. Okay. So this can be applied on other pairs other than Euro USD. So we look at those pairs also. However, up to now, I'd like to thank you for listening.